Good morning, grade 11s and educators at large. My name is Mr. TMC Bitro. I'll be working with you through the income statement and as well as the balance sheet and notes. Right. This is part of paper 1 in our grade 11 accounting. Right. Now, the income statement and the balance sheet. Let's first start with this nice question whereby they give you this set of information and they say choose a description from column B that matches the term in column A. Write only the letter A to C next to the question number. Now the numbers are 1.1.1 to 1.1.3 in the answer book. Now the first one is the balance sheet. Now you need to choose the correct description that goes hand in hand with the balance sheet. Number B says, reflects the financial position of a business on a particular date. Number A says, the difference between current assets and current liabilities. And then number C says, reflects profit or loss for a financial period. So the most appropriate one here will then be number B. For 1.1, so 1.1 goes hand in hand with number B. So our balance sheet is reflect the financial position of a business on a particular date. Then the income statement will go with number C, whereby it says reflects profit or loss for a financial period. So that is the description of our balance sheet and our income statement. Then the net working capital will then go hand in hand with number A, which is the difference between current assets and current liabilities. Now, I deliberately started here by knowing the description first before we move into the balance sheet or the income statement. So we got the descriptions between the two, whereby the balance sheet reflects the financial position of a business for a particular date, and then the income statement reflects the performance of the business. So now for us to do the income statement, it is important that you know your format very well. So even if you can give yourself some time to study your format, a skeleton of the income statement, that will do you very well in the long run. Now I'll be working through some past papers, and one of the past papers that I'll be working through will be one of the 2016 November past paper. The November 2016 past paper. Right, so the first attempt will be on the income statement. Now when we look on our set of information, they say we start with an asset disposal, income statement, and notes of trade and other receivables. Right, so you are provided with a pre-adjustment trial balance of RS Traders, a partnership with partners R Rambo and S Mariva. Now what is required, we first need to start with the asset disposal account and then 3.2 income statement for the year, then we look into our fixed asset note as well. So the income statement will then be done after immediately we've done the asset disposal account. So now let's look at our set of information. The first thing you do when you now analyze your information is to look at this information. Do not neglect the top part of your trial balance. It has very, very crucial information there. So it tells us RS Traders is the name of the business. It's an extract from the pre-adjustment trial balance on 29 February 2016. So this is important. It tells us the timeline, the financial year, when it ends, which means it ended on the 29th of February 2016. Then on the same, or in the same breath, you need now to know that it means it started on the 1st of March 2015. So this will then be your start. Right, so this top part helps you to determine your financial year. So it's 1st March 2015 until 29 February 2016, because in accounting we work with a timeline consisting of 12 months. Now it's very important to determine that so that when you work out your adjustments, then you know how to work out your accrued or your income received in advance or your prepaid expenses in line with the GAAP principles. Right, now here you have your set of information related to this business. You have your set of information. Remember, you have a balance sheet section and a nominal section. There's a reason for that as well. Mostly when you do your income statement, the focus will be on the nominal section, and then later on you'll move to your balance sheet section as you need to work out maybe your interest on fixed deposits, or when you need to work out your depreciation on your assets, or when you need to work out your interest on your loan. Then only you will work from your balance sheet section, because these accounts are mainly used in the balance sheet. Then the nominal account section is what you use for the income statement. Now, 3.1 required from us to do the asset disposal account. Let's start from there. Right, so now on our information asset disposal account, that's our answer sheet. Then on the set of information, we will look for an adjustment that talks about where we have sold an asset. Right, when I look into the information, adjustment number 12, it tells us old equipment was sold on credit on 31st December 2015 for 45,000 rand. Right, which means we sold it on credit. The fixed asset register showed the following entries concerning this equipment. Now, number one, it shows us how much was the cost price on this particular equipment. Then it also showed us what was the accumulated depreciation at the beginning of the financial year, because we've used this asset in the previous years, and how much depreciation has accumulated thus far, 32,000. Now then, there's also very important information. They say this transaction was not recorded by the bookkeeper. So no entries was made with regard to this transaction. Right, which means now we need to do the asset disposal account. Number one, the first thing you need to ask yourself, what am I selling? When we look in our information, it was clearly written there that we are selling equipment. So on the debit side of the asset disposal account, you will write then there, equipment is what I'm selling. Then that equipment, what was the original cost price of the equipment? As per the fixed asset register, it shows us there that the equipment was 80,000. Then you slot in the 80,000 there. Now the next movement will then be to ask yourself, how did you sell this equipment? How did you sell this equipment? You sold it on credit. And once you sell it on credit, it means someone is owing you money. And who is that someone? We classify that someone as a debtor. So then it means the 45,000 is money that I have with someone, and who's that someone? A debtor. Now I leave a line open there and write there debtor's control. How much am I supposed to receive from the debtor? 45,000. Right? Then the next item will be what was the accumulated depreciation on this particular asset for the whole financial year? Which means that accumulated depreciation, I must also now transfer it in the asset disposal account. Remember, this is your credit side, there's your debit side. So on the credit side, we then transfer the accumulated depreciation on this particular equipment. Right? So the accumulated depreciation of the equipment, you start always with the accumulated depreciation of the previous year. And was it given to you? Yes, it was given there on the 1st of March 2015, 32,000 rand was the accumulated depreciation on this particular asset. Then you transfer it in there, 32,000. Now what's left is, we need now to work out for this financial year, what was the depreciation on this equipment? which we sold, and that we will add here. Now we take another step forward to go and look at what the depreciation methods or procedures are. When we look into our information, they say, provide for depreciation as follows. What did we sell? Equipment. So we go straight to equipment. They say equipment at 10% per annum on the diminishing balance method. So it's very, very important to know which method is the diminishing balance method. And if we still remember what the diminishing balance method is, it means you need to take your cost price, then subtract your accumulated depreciation on that particular asset, then only you can times it by the rate, times it by the time you used that particular asset, like the equipment, in this financial year. Then it will give you the depreciation. So let's now look at the cost price of this particular asset. The cost price was transferred in there as 80,000. So now we write there, the cost price was 80,000. So it's 80,000 rand on this particular asset, which is equipment. Then what else do you need? Accumulated depreciation. The accumulated depreciation, you take that one which was at the beginning. So we subtracted the 32,000, right? So that difference will give you then the diminishing balance method or the carrying value or the book value. So the cost price minus the accumulated depreciation gives you now the carrying value. Now the next step will be to multiply it with the rate. What was the rate? As per our information, they've given us the rate at 10%. So you put your 10% there, then you multiply it. Now you ask yourself, for how long did we use this particular asset? You go back to your set of information, you check. This old equipment was sold on the 31st of December 2015, which means on this particular date, this asset is now gone. We no longer have it. But it means we used it from the 1st of March until the 31st of December 2015. Now, how many months is it when we count from 1st March until the 31st of December? So when we count it should be about 10 months. So for 10 months, we used this equipment. Therefore, we need to account for its depreciation. So the depreciation, when you work it out, it should then give you 4,000 rand. Right? So what is this? This is the depreciation on the equipment which I sold. And now I need to transfer it into my asset disposal account. Why? Because this equipment, is no longer part of my books. So I'm taking out its depreciation. So when you add those two, 32,000 plus the 4,000, you should then have there 36,000. We've worked out the accumulated depreciation. Last year it was 32,000 plus this year for 4,000, right? Then it gives you 36,000. Now, next movement, we need now to check, did we make a profit or did we make a loss on this particular equipment? So you need to check which side is the biggest, right? When you take 36,000 and you add it with the 45,000, it gives you 81,000. So when you add this side is 81,000, this side is 80,000, which means your credit side is bigger. We use that then as total for both sides, 81,000 there, right? Then the difference between 81,000 and 8,000, how much is this side left? It's 1,000 on that particular side. So then we'll be able to determine, was this a profit or was this a loss? Then here we can say it's a profit on sale of asset. So we've made a profit of 1,000 on sale of asset. Then as we are doing the asset disposal account, remember this information becomes crucial for the income statement. So this will then be transferred to our income statement under a particular section. But before we go there, let's just look into our asset disposal account, what we've done. The first thing was to transfer the cost price of the asset that you are selling on the debit side here. Then, either way, you can either start by transferring the accumulated depreciation of the previous year there. Then you need to work out the depreciation of the current year on this particular equipment. And there we've done it in this manner. So the total there shows us how much of accumulated depreciation was written off on this particular equipment when we used it for the financial year. Then how much was this sold for? It was sold for 45,000. Then this 45,000, it was sold on credit. Therefore, we've created a current asset, which is a debtors control. Right, so that is how the asset disposal account will look like then. Then immediately hereafter, since you've done this and the very same information will still be needed in the income statement, then you can immediately, because it's a profit, you can now immediately transfer it under your income statement as profit on asset disposal. So we can put it there as profit on sale of asset. Then how much profit did we get? We got 1,000 rand, so we slot in the 1,000 rand there. Then immediately, simultaneously, you've been earning marks. You don't leave it for whenever you come now across the adjustment that says determine now the profit on sale of an asset. So as you finish with it there, transfer it immediately at its place where it is supposed to be. Now, if this was a loss, it would appear on the credit side, meaning your debit side will then be bigger, then the loss will be on the credit side, then immediately on your income statement, you will put it under your expenses as loss on sale of asset. But in this case, it was a profit. Right, then the income statement itself, remember it's important to know your format, to know the skeleton. That cannot be overemphasized. And once you know your format and your skeleton, it makes your job much easier. Then on the income statement, very important, you always start with your sales. Then on the sales, you will open your bracket to start with the amount that you have on your pre-adjustment trial balance. So you move back to your pre-adjustment trial balance, you look for your sales, remember the nominal section, there's your sales, the sales is 950,000. So immediately you slot in your 950,000, right? Then after slotting in your 950,000, you need now to look at adjustments which affected the sales. Or you need to look at your debtors allowance. Was there any allowance from the trial balance? When we go to our information and look there, you have debtors allowance. The debtors allowance amounted to 19,200, so immediately we slot it in there, subtract 19,200. And this has been coming with you since grade 10. So it's your sales from the pre-adjustment trial balance, subtract your debtors allowance. Then immediately after this, don't now close your working before double checking. What do you need to double check? Check, wasn't there any or isn't there any other adjustments which affected the sales? Things like returns which were not recorded, or maybe there was a sale which was not recorded and it affected this. So let's go and check in our adjustments. Wasn't there any other adjustment which affected our sales? When we look into the information, adjustment number 1 says a debtor returned goods, so immediately it's an allowance. A debtor returned goods to the value of 6,000. So that is the value of the goods, 6,000. The cost of sales amounted to 4,000. No entry was made in the books concerning this transaction, which means this transaction will therefore affect our sales. So how will it affect our sales? Negatively. So it's minus 6,000 because you allowed the debtor to return. Now remember, this very same adjustment will also now affect our cost of sales with that 4,000. Therefore, as you are doing it, simultaneously go to your cost of sales, start with the amount coming from the trial balance. So on the pre-adjustment trial balance, that extract, you need to go and look at how much your cost of sales is, and your cost of sales there is 950,000. So then you'll take, sorry, that was your sales now. Let me just check. I've now interpret the information here. The sales is 1,900,000. There's 1,900,000, right? And here the 950,000 comes in here. 950,000, right? Let's just check again. You see these lines can sometimes confuse the eye. So sales there, it goes to 1,900,000. I've just rectified it there. It's 1,900,000. And then the cost of sales, it is 950,000. So there, 950,000. Just rectify that one quickly. Then we spoke about this adjustment. It will affect the cost of sales as well. So it will be minus 4,000 in the cost of sales, right? Because these goods were now returned. You no longer have that cost of sales which you've imputed as an expense, right? So 950,000 subtract your 4,000 of that return, and under sales it will be the 1,900,000 minus 19,200 minus 6,000. This comes from your return. This was your debtor's allowance. Now before you close again, do double check and check for other adjustments which affected the sales. So when we look at the next one, it talks about the partner Rambo took 500 worth of stationery. So it has nothing to do with the sales. So we can close our working there and then get the total of that particular sum. So when we subtract everything there, your answer should then be 1,874,800 rand. Then when we subtract these two, your answer should then be 946,000. Then very important to indicate there with brackets to show that decrease. It's very, very important to indicate the brackets. Then when you subtract your sales from cost of sales, you should then have your gross profit. Then the difference when you work it out, it should be 928,800 rand. So very, very important to subtract and show the brackets which indicate that you did subtract, right? Then there you have your gross profit. And then now the next movement will then to move to your income, right? Under your income, you have rent income. Then rent income, you start with your amount or figure coming from the pre-adjustment trial balance. So when you move into your pre-adjustment trial balance, you look for rent income. There's your rent income. This time we must now move correctly, right? So it's 96,250, right? So 96,250 is what we have from our pre-adjustment trial balance as rent income. Now we need to look for an adjustment that talks about the rent income. When we take our set of information and we look at it, adjustment number 7, it says the rent included the rent from March 2016. Take into consideration that the rent increased on 1st November 2015 by 15%. So the rent increased by 15% in November. So it's then very important for us to go back to that story of the timeline, we said our financial year start 1st March, and then it ends 29 February 2016, and there's 2015. Now, here on the set of information, say March 2016 is included in our rent, which means March 2016 should be immediately after February 2016. So March 2016 is there. Then they also tell us another set of information. They say, consider that the rent increased in November. So November should be somewhere there. November 2015. Now the rent increases with the 15%. Now, remember on the pre-adjustment trial balance, we got our rent there as 96,250. Because of this element here, we cannot now say, okay, we've received rent for 13 months, therefore we can just divide this by 13 months, the 96,250 by 13 months to see how much it is monthly. We cannot do that because of this element here. Now, we'll do it in stages. Let's look at number 1. Before the increase, before it increases, how many months did we receive the rent? Which means we need to check, okay, the rent was increased on the 1st of November. Now we need to count from March until before November, because 1st November the rent is changing. Then when we do our counting, we must or we should get round about 8 months. We've received an amount before the increase, which should be 100%. Anything before an increase should always be then 100%. Then, it's 800 there. Secondly, look now at after the increase. After the increase, what happened? We've increased the rent from 1st March with a 15%, which means from November till March 2016. How many months is it there with an increase? We have then about 5 months there with an increase. Right, now something happened. It has increased with a 15%. That 15% becomes now 115. Where does 115 comes from? 15 plus 100. Then it gives you that. So 115. And what will our answer be there? So our answer, we will now say 5 multiplied by 115. It gives you 575. Now add the 800 with the 575. It's then 1375. Right? Now go back to what the rent in total was. The rent in total was the 96,250. So we take the 96,250, 96,250. We divide it with this 1375. We multiply it with 115. Then the answer, when we do it, 96,250 divided by 1375 multiplied by 115, then the answer is 80,050 or 8,050. 8,050. This is our monthly rent we received with an increase. Which means if we have received 1 month in advance, it's only this 8,050. So this 8050 is what we have received for 1 month in advance. Now when we move into our answer sheet, on the answer sheet, remember there, you've started with the one coming from the pre-adjustment trial balance. You need now to subtract 8050 or the 8,050 as income received in advance. Then the difference between the two should give you then how much the rent is actually supposed to be for this financial year. It's 88,200. Because we only report about income and expenses which incurred in our financial year. So 88,200 is what we can report about. Then the next one is your discount received. Now the discount received, when we look into our pre-adjustment trial balance, the discount received is given there is 4,234. 4,234. Now that figure, we need to transfer it as a working under the discount received in the operating income, but we need to double check, is there an adjustment? If there is no adjustment, we can just transfer it as it is in there. 4,234. Right. So we've done the rent income, discount received, profit on sale of asset. Now we need to look at, isn't there any other income apart from these three? When we look into our information, these were the only three income. If there was provision for bad debts, adjustment, which decreased, then we could have also slotted it in here. Or if there was bad debt, provision for bad debts, recovered, then the adjustment figure decreases, we put it in there. Right, so in this case, those are the only ones going in there. But let's look into our adjustments to verify. Right, to verify, is there any other? Right, when we look at adjustment number 10, adjustment number 10 says the provision for bad debts must be adjusted to a 3,000. Now we need to go and check, if they say we must adjust it to 3,000, how much did we provide? When we look into our pre-adjustment trial balance, we go for provision for bad debts. Provision for bad debts is 2,980. Now they say, take it from there and move it to a 3,000. So something happened. It means we have provided less. And how much is needed to take it to the 3,000? We will look at the difference. So when you look at the difference of these two, the difference should be a 20 rand. Now that 20 rand is what we added. So the provision for bad debts is increasing, which means it will not fall under the operating incomes. It will then fall under your expenses. So here under your expenses, we can then write the provision for bad debt, the adjusted figure. We've adjusted it with how much? We've adjusted it with a 20 rand. So when the provision for bad debts increases, that portion that increases goes under your expenses. If it decreases, that portion that decreases will go then under your income as provision for bad debts adjustment, then it would have been slotted in there. But in this case, it has increased, we put it under the expenses. So when we add all our operating income, it gives us 93,434. So the gross profit plus the operating income should give you gross operating income as 1,022,234. When you add now these two, which one are they? They are your gross profit and your operating income. When you add them, they should give you gross operating income. Right. Then the next movement, we go to our expenses. Under our expenses, we have salaries and wages. Now, salaries and wages, we go to the information. under the information, we have salaries and wages there as 152,500. Remember, immediately you slot it in there, 152,500, right? So you need now to go and look for salary or wages which was omitted or which the bookkeeper forgot to include. And when we go under our adjustments, we create adjustment number 11. One of the employees were omitted from the wages journal for February 2016, right? Now, when we look there, gross wage is unknown, and this is the figure we need. Then they gave us deductions, they gave us contributions, they gave us net wage. Now, to move back to the net wage, to the gross wage, we need to take net wage plus the deductions. Then we will have gross wage. Means we need to take 11,300 plus it with the 2,400. Then you'll get your gross wage. That is what we must add in here. You have two choices. It's either you put it separately, 11,300, which is the net wage, plus your deduction of 2,400. Or you can add it together and get a figure which will then be 13,700. Two ways to do it. It's either you put it separately or you add these two and put it in as 13,700. Then, when we add everything up there, your salaries should then be 166,200 rand. That should then be your salaries. In the next movement, you have your employer's contribution. Again, you always start with the figures coming from the pre-adjustment trial balance. So from the pre-adjustment trial balance, when we look into our set of information, we have then there employer's contribution as 25,600. So we will then take that 25,600 as it is, slot it in here, 25,600, plus it with employer's contribution coming from the adjustment we just read, adjustment 11, there's a contribution. So we plus the contribution in there, 3,600. When we add the two, you will, or you should then have 29,200. Now remember, the answer sheets differ. Sometimes you can put the employer's contribution in the workings of the salaries and wages if they did not provide a space for the employer's contribution. But if there's a space provided for the employer's contribution, then you need to put it at the relevant place. I repeat again, answer sheets differ from answer sheet. If the salaries and wages was the only item shown in here and there's no space for employer's contribution, these items can also be put in under the working for salaries and wages. But if there is space, you can split them, no problem. Then the next movement, we will then move to advertising. Under advertising again, we start with the amount coming from the pre-adjustment trial balance. When we look at advertising there, your advertisements were 15,150. So then there, 15,150, right? Let's go and look for an adjustment that goes hand in hand with the advertising. It's adjustment number 4. Advertising included an amount of 1,200 in connection with March 2016. Now remember our timeline. We have a timeline stretching from 1st March 2015 until 29 February 2016. Now can you see that much which they are talking about? It's outside our financial year. Therefore, it's a prepaid expense. We need then to take it away. We need to deduct that 1,200 because it's a prepaid expense. Then the difference between the two, the 15,150 and the 1,200 should then be 13,950, right? Because it was a prepaid expense. Now we go for bad debt again. Start with your figure coming from the pre-adjustment trial balance. figure coming from the pre-adjustment trial balance. When we look at our information, bad debts, there we have 7,020 for bad debts. So we put it in 7,020. We need now to look at an adjustment that talks about bad debts. Right? Adjustment number 9. They say a debtor M. Mambo, whom owed the business 1,700, was declared insolvent. So he's now insolvent. He cannot pay anymore. His estate paid out 40 cents in the rent. So 40% of this has been paid by the estate, and very, very key, here they say, and was correctly recorded. The balance must be written off as irrecoverable. So what was recorded? Only the 40%. What is the balance? The balance should then be 60% or 60 cents. How do we get it? We will then now say, okay, he owed us 100 cents or 100%. Then he's able to give us 40 cents we received. Then what is the balance? 60 cents we did not receive. Now next movement will then be, how much does he owe us? He owes us 1,700 multiplied by 60 over 100. Why over 100? Because this was the original debt. So 1,700 multiplied by the 60 divide by 100. It gives us then 1,020. This is the figure we will never get anymore. It's the bad debt. Now we need to write it off. So when we write it off, we'll then say there plus 1,020. So the bad debts are increasing with the 1,020. Then the total there becomes 8,040. 8,040 is a total there. Right? Then stationery. When we look into the stationery, there is from the pre-adjustment trial balance, stationery amounts then to 28,700. So we put in there 28,700. Now we need to look at adjustments which affected the stationery. When we look at the adjustments, adjustment number 2, partner R. Rambo took 500 worth of stationery for own use on 25 February 2016. This was not recorded yet. So that's drawings of stationery. How will it affect our stationery? It will decrease our stationery with a 500. Then when we look into our information, we also have adjustment number 3. Adjustment number 3, which talk about inventories on hand, were as follows on the 29th of February. The stationery was unused. It's on hand. So it means from the total we bought of stationery there, we need then also to subtract the one that is on hand, which is 1,235. Close the bracket. Then the sum should be 26,965. Now we go for insurance. Again, start with the amount from the pre-adjustment trial balance. The insurance there is 18,680. So it's 18,680. Then we go to the adjustments. Right, they tell us there the insurance. Where is it now? The insurance included an amount of 2,160 for the period 1st September 2015 till 31st August 2016. Again, August 2016 is now stretching outside our financial year. When we look at our financial year, remember we said our financial year, it stretches from 1st March 2015 until 28 February 2016. But now the insurance has been taken out there 1st September 2015 until August 2016, right? So 1st September until August 2016. Our financial year ends there. So anything after the financial year there is then prepaid or in advance. Right. So remember we said in our pre-adjustment trial balance, the insurance is about, let's go and check it, the insurance is about 18,680. So that's 18,680. That's the total of the insurance, right? But included in that total, there is now an amount of 1,260. Let me just verify it again. And the insurance, no, it's 2,160. That's it. So they say included in that amount is 2,160. So 2,160, it's included in this particular amount. Now from there to there, it's about 12 months. So as a result, we will then take 2,160 divided by 12. It means per month, when we take 2,160, we divide it by 12, then it gives us per month is 180, right? Now the 180s, which are for September until February, they are okay when they are included in there. But all those ones after February is now then in advance, which means March, April, May, June, July, August, the 6 months, 180s. So multiply by 6, it gives you 1,080. So the 1,080 is not for our financial year, it's prepaid expense. Then we will have to exclude it. So minus 1,080. Then the difference between the two will give us 17,600 as our insurance. Now from there, we move to our telephone. The telephone, as per the pre-adjustment trial balance, when we look at telephone there, telephone is 25,540. We slot it in there, 25,540. Now we need to look at an adjustment that talks about telephone. Number 6, it says the telephone account for February 2016 is still outstanding, so it's accrued with 1,025. When it's accrued, we need then to add, so it's plus 1,025. When you add those two, the telephone should then amount to 26,565. That's now the insurance. Right. Then, remember we also have to work out then the deficit on trading stock or the surplus on trading stock. Now, in the trading stock issue, we have adjustment number 3. Inventories on hand were as follows. Trading stock on hand is 18,550. 185,250. This is what's on hand. It's what we are left with. But we need now to start with how much is the trading stock from the pre-adjustment trial balance. Now we move to the balance sheet section because now we talk about trading stock. So trading stock there, we have 18,800, 182,800. So we start by saying, as per our books, we have 182,800 rand. This is what we have on our books, right? Then, before we use that one which is on hand, we need to look for adjustments which affected the trading stock. Remember the adjustment number 1. This adjustment, whereby where goods were returned, that cost of sales will affect the trading stock. It will affect the trading stock because now that stock was returned. So if stock is returned, it will increase the trading stock with the 4,000. It's coming from that return. Now, when we add the two, the 18,800 plus the 4,000, we will then get 186,800 Rand. This is what the records are showing. Our inventory is supposed to be this. But when we do our physical stock count, we end up with a figure of inventory on hand of 185,250. 185,250. Now, when I look at what the records are showing, and when I look at the count, this is when we do our physical stock count. We have 185,250. Then definitely it shows that there is a shortfall of the difference. And that difference is then 1,550. Therefore, we will put it under expenses because it's a deficit. So under your workings, you will start by writing trading stock, and it's important to write it in full, trading stock deficit. Don't just write trading stock because there's a difference. Then we start with the 182,800. We add our 4,000 of the return, subtract the on hand of 185,250. Then the sum of everything up here should then give you 1,550 as your trading stock deficit. Now, when we look into the income statement, we still have to look into depreciation. Then depreciation is also one of the items that should go in here. Depreciation. So the depreciation, we start with by opening our bracket. Do we have depreciation coming from the pre-adjustment trial balance? No, we will not have it there. Then it means we need to go to our adjustments. Remember, we already worked out the depreciation on equipment. Right? If we can still remember adjustment number 12. Right? The adjustment number 12, the depreciation we worked out here, which amounted to 4,000. Right? You still remember that one? We will then slot it in here as 4,000 as the depreciation we worked out for this year. And that was only the depreciation we worked out on the sold. We need now to work out the depreciation on the remaining. Again, we follow the diminishing balance method. We need to check how much was the cost price at the beginning on equipment as per the trial balance. There they say the cost price on the equipment is 245,000. So we will use that 245,000. Right? Now there was an asset which was sold. Remember, we sold an asset. We sold the equipment which costed 80,000, which means we will subtract it from there, minus 80,000. This is the cost price of the sold one. This is the cost price at the beginning. Then minus, we need now to talk about our accumulated depreciation. Accumulated depreciation at the beginning, when we look at the pre-adjustment trial balance, the accumulated depreciation on equipment is 95,000. So we take that 95,000 as it is, then subtract the accumulated depreciation on the equipment which was sold, but the accumulated depreciation at the beginning, remember it's there, the 32,000. Then thereafter we can say times the percentage is 10%. Then we can say times, remember they are remaining, which means it will be for a full year. And when we work out this, the total there, it should then be 10,200 as your depreciation. On what? On the remaining assets. Now we take it and transfer it to our income statement under depreciation plus 10,200. Now this is only the depreciation based on the equipment. We need now to work out the depreciation based on the vehicles. When we look into our information, vehicles is 448,000. 448,000. So 448,000 is the vehicles. That one was equipment. So the vehicles, we need to go and check which method are we using. When we look into our information, it clearly states there that on vehicles, it's 15% per annum on cost, which is the straight line method, on cost. Meaning we just take our cost price, multiply it with the rate, multiply it by the time, then it gives us depreciation. Then we need to look at, wasn't there any adjustments which affected the 448,000? They say, take note, a new vehicle of 180,000 was bought on 1st September 2015. This was not recorded by the bookkeeper, which means it did not affect that figure. So we'll just say that times the 15% times, now we had them for a full year. So it will then be 12 over 12. When we work it out, it should be 67,200. Then next, remember they say we have a new one. Here under vehicles, we did the remaining one, the new one. So under the new one, they said on the information, a new one was bought 180,000. So the cost price 180,000 times 15% times, now we need to determine for how long did we use it. They said it was bought on the 1st of September 2015, which means I now count from 1st September 2015 until the end of the financial year. And it should give us then about 6 months, from 1st September till February, it's about 6 months. And when we work out this sum, it gives us the depreciation as 13,500. Right, so again, we transfer that answer in here, plus the depreciation of the vehicles which remained, 67,200, plus the depreciation on the new one, 13,200. And when we work out everything there, the 4,000 plus the 10,200 plus the 67,200 plus the 13,200, which is equipment and vehicles together, the depreciation has to amount to 94,900. Now when you add up everything here, you will have your expenses totaling at 384,990 in brackets. Then the difference between those two will then give you operating profit as 637,244. How did we get it? Gross operating income, subtract operating expenses. The difference gives you then operating profit. Then operating profit. After operating profit, you need then to have your interest, the interest income. Right? You need to have your interest income. Then when we look at the information, interest on fixed deposit, 4,500. When we look at our adjustments, there's no other adjustment regarding interest. So then there will be 4,500. We add it as it is. It will give us then a total of 641,744 as our profit before interest expense. Then we have interest expense. Right? Then the interest expense, we need to look at the adjustments now again. When we look into the adjustment, we have then adjustment number 8. Interest on loan was capitalized, meaning it was added to the original loan amount. The loan statement received on 26 February 2016 from AB Bank reflected the following: balance at the beginning, interest capitalized, and then monthly payments according to the loan agreement, 72,000, balance at the end, 214. Now normally what I do when I come across such, I quickly reconstruct a loan account. Now because they say the interest is capitalized, increases there, decreases there. I will start with the balance that they've given me at the beginning, which is that 280,000. I slot it in there. Then my interest needs to be on this side because it's capitalized, but I don't know it. Then they've given me repayments 72,000. So I put it there, 72,000 on my debit side. Then I slot in the closing balance. There's a balance at the end. The balance at the end is 240,000. Then here, a balance carry down is 240,000. Now the only figure that is outstanding there is the interest on loan. So what do? Add these two, subtract the 280. So it's add, subtract 280. So it means it's plus, subtract that one, then you'll get this one as your answer. Then the answer there should then be, when you work it out, it should then be 32,000, which needs to be in brackets. Then that 32,000, when you subtract it from the profit before interest expense, will give you a net profit of 609,744. So this is how your income statement looks like in the end, right? It's one of the items which you shy away from answering, and you can score great marks in the income statement. And remember, as you start doing it, you always start with your amounts coming from the pre-adjustment trial balance, then you consider your adjustments. As I normally say, what's important here is your formats. Formats cannot be overemphasized. So that is the end of the income statement. We will then end it just there. Thank you.